Hi, everyone. So thank you for coming and welcome. Maybe we start with a quick introduction, a few words. So, I mean, most of you know Matt, but anyway.
Yeah, is it working? Yeah, it is. Yeah, so like you said, most of you probably know me, but I run the digital asset business at Goldman Sachs. I've been at Goldman Sachs since 2005, so quite a veteran there. And prior to that, I was at Morgan Stanley.
Thank you. I run Ownera. I'm the founder and CEO. We provide interoperability, connecting banks, buy side, sell sides through our routers to enable interoperability from everybody to make this market scalable. And I think that the subject of this discussion is about scalability. So the first question I will ask you, and that will basically be the basis for the entire discussion. It's 20 minutes, we can talk about it for 2 hours, but what is actually needed in order for the tokenization market in the institutional space to actually scale to the levels that people expect it to scale to? Because if you look at the research, Citi published a research saying that there's going to be a $5 trillion market by 2030. There's another research talking about $16 trillion. How do you get from not one trillion to within 4 or 5 years? What do you need to do in 29? What do you need to do in 28? And what do you actually need to do in 24 and 25 to make it happen?
Yeah, no, with great difficulty. No, I'm joking aside. I think this is kind of one of the key areas that I've been focused on now, really, for the last kind of 12 months. And as you think about the business that I run, we've been going for kind of 4 years, and business, the heads of the global markets division, and I'm a firm-wide team, but my team predominantly sit within global markets. They want to see how this business will truly scale. And to do that, I think there are kind of 4 key things in my mind. One, and all of them are kind of reasonably kind of obvious, but regulatory clarity, and I know Scott kind of touched on that. I'm a little bit more positively predisposed to the direction of travel. I think there's been a huge amount of progress. Clearly we want more, but there has been progress. I mean, a lot of what we do actually fits within the existing regulations, but it's just getting that clarity. And there's no coincidence that clarity has then seen a swathe of buy-side, sell-side, FMIs become much more actively involved in that last 6 to 12 months. And I think that's a hugely positive step, but still, a lot more to do in terms of their involvement. The second one is really kind of project selection. There's always a proof of concept that one could be kind of focused on. I'm afraid that's something that we just don't do. I think for me, really now, the focus is on scalability and making sure that there is a commercial relevance to whatever project it is we're working on. And what do I actually mean by that? I mean, it's actually creating, be it on our platform or on somebody else's, a marketplace where you have, the key market participants from the analog markets trading in the same way they do, but just on digital rails in a much more efficient, kind of way that, for many different reasons that we've talked about before. So that really is key, scalable, commercial. And then when you start to think about liquidity, that is really kind of interwoven in that, because one of the problems we have now is the buy side, they have the teams, they have the strategies, but there is kind of a hesitancy to actually get involved, and some of that is down to a lack of liquidity. And that's why you still see real trades, but just very limited trading. And so as people now focus more on that secondary liquidity, be that in the EU pilot when people start to become more active there, or in other kind of jurisdictions, and we've got a few things that are focused there. Once you actually kind of have that, that becomes really powerful and quite self-fulfilling in my mind, because secondary liquidity, trading venues active, that means then the buy side can come in the swathes, and then you can start to issue more product, and then you increase the cadence. So those kind of 3 things are really kind of key from my side. And it's kind of down to the supply and demand, I guess, to your.
So maybe you start to unpick some of those. So let's talk about the regulation. There are some opinions here that the regulatory structure is maybe unclear in some spaces and so on. And I think that yes, indeed, there are places like, for example, secondary that requires a CSD, things like that, where some things needs to be done. There's also an element of educating regulators, but I think the core element of most everything that we're doing can actually fall within existing regulation. I mean, if you look at the alternatives market, the current regulation requires people to speak with each other on the phone, right? And keep their stuff on an Excel sheet like they've always done, and send PDFs to each other. So if we keep the same roles and responsibilities, we just put it on DLT and make it more transparent, make it more standardized, reducing all the problems with reconciliations and so on. You just improve on current scenario within existing regulations. You just have to explain it in a better way. So I think there's a difference between those applications that require stuff that is new and a difference between the applications that are actually doing the same as what we're doing today, and we need to know the difference between them.
Yeah, and it kind of feeds, actually coming back to your first question, you actually think, and people don't like to talk about the internal governance, but it is something that's absolutely key in terms of being able to accelerate these projects, certainly through the kind of sell side, and I'm sure the buy side as well. And really having a crisp process that you can kind of demonstrate to the regulators that you're asking the right questions, you're thinking about the risks, is kind of key. I know it kind of may sound a bit boring, but it is actually key and fundamental to driving this forward. Regulators, from my experience across the globe, actually are exceptionally knowledgeable about this space. They've really built up, from talking to all the institutions I'm sure here, and many others, a wealth of knowledge, and they're just building their teams up. And I think that, again, is something, going back to that regulatory clarity, is it permissible within the existing rules? What do you need to advocate for? All these types of things. And actually having people who understand is hugely valuable. And I've noticed a big sea change there. So I'm actually kind of excited in terms of that knowledge. And if anything, they're probably a little bit frustrated in terms of, kind of the lack of progress they see. Europe being a really good example there. So I think it's just that. I think as people kind of work on particular deals, it's really thinking through kind of what are the key aspects that you do need that little bit of clarity on. Because there is a lot of prudential oversight. I don't think anyone, particularly, from the US bank's perspective, and it's just positively dealing with that.
Yeah, I agree. And on the commercial side, I think one of the key elements about tokenization, we were talking for a very long time about the technology, because the technology was, a thing that had to be conquered. I think we have the technology now. I don't think within Ownera we have one project where the technology is the limitation. We've built the technology. It kind of worked. The tokenization is I wouldn't say commoditized, but is available. And then on top of it, all sorts of use cases are being built for bonds and real estate and repo and whatever. And also the interoperability is available through routers that can connect everybody. So it's not about technology. But now it's going to the commercial side. How do you find the actual sponsors within the banks? The commercial sponsors. And I wanted to ask you, where do you see those low-hanging fruit applications where it's clear value, immediate value, the commercial people should have no reason to say no because it's just going to make them more money or save them a lot of money?
Yeah, and I guess you kind of touch on a key point, and going back 4 years when I took over the business, for me it was key you were in the business, because then you're close to kind of all the different markets, and you can actually start to see as this technology evolves across different asset classes where it actually can be most commercially viable. I think the honest really kind of answer is you need to understand kind of how this technology will work and how it will transform different markets, and how then you articulate that to whatever, the head of whichever respective business that is, be it commodities or be it the mortgage market or, kind of the repo desk. And so I think Scott kind of touched on a little bit of this. I mean, I see kind of where you can really kind of extract value today is in that collateral kind of mobility, the financial plumbing of the market. There's many people who are already starting to trade on the JP platform. We do, and we can see the value proposition has changed. The risk profile of that transaction has changed. Again, something I've talked about a lot. But as you now start to see more of the buy side want to get actively involved in intraday and see a two-way market flourish, you can see then how that will be truly transformative. That's a market that really doesn't allow two-way trading today. And to do that, to then be a lot more efficient in terms of how you move that kind of liquidity, through the day, following the sun, will be very powerful. So I kind of think that that's one key component. I also think, as people familiar with the collateral markets will know, collateral tends to be allocated on a T+1, T+2 pricing basis, which kind of brings a lot of inherent kind of jump risk into the market. That ability to allocate T+0 pricing, which really isn't a huge leap, again, is very powerful, because it means then you need to hold less of a capital buffer, which means you can free up some of that expensive capital and apply that to other businesses where you can kind of monetize that. So I kind of feel the financial plumbing continues to me to be something in that kind of medium term we'll really start to see a lot of benefit across the market. I think tokenization is kind of something that is a slower burner, but it will be transformative because, everyone talks about digitizing the life cycle and how you can extract value by removing, various different intermediaries and the like. I do think there are efficiencies. A lot of them actually come into the fact that you can be more precise with your use of liquidity and capital. Again, just kind of leveraging something Scott said, when you think of Basel IV and you think of the focus on liquidity and capital, costs are going to go up. It's going to become more expensive. And so if you can actually be much more efficient with a key resource, that actually is, pretty powerful for whichever entity it is that you work for. And then if I look at kind of the buy side, just playing on that side of the fence, this ability to potentially invest in green debt, for example, that's native to a blockchain, the transparency that they can get to be confident there's no greenwashing, things like that where you're using the enhanced functionality of the technology becomes very powerful. And we're starting to see, there's a lot of buy side that have a lot of cash that they want to put into that market, but just can't see kind of product that works. So again, you're addressing a market real problem by using the technology in a positive way. I think digital money is something that is going to be an enabler, and I think there's probably going to be many different kind of threads to that. There's obviously the kind of digital deposits, and I do think wholesale CBDC, central bank digital currencies, will ultimately, over the medium term, play a very profound and important role there.
So yeah, you mentioned quite a few. I'm going to add a couple of my own. In the liquidity space, still in the liquidity space, we're seeing the money market fund, tokenized money market fund is a huge opportunity. And we're, a little spoiler, we're going to present something new in the money market fund today at 3:30, so please show up. Yeah. But the idea behind money market fund in a tokenized manner is that if, let's take a simple example of a company managing their own treasury and, raise 20 million. We have companies here that raise $20 million. What do you do with the $20 million, right? Or a fund that raises capital, or any other company that manages treasury. Today, the optionality is not great because you can put the money somewhere, but then to get it out, you need whatever you did, 3 months, 6 months, and then plus 2 days and so on. If we can offer a tokenized money market fund, we can just go in and go out whenever you want. On the day, or sometime even by the second, just click a button and you get your money back, and you still get the high yield of a money market fund. This is a transformative use case that isn't available in the market today. And I think the tokenization industry needs transformative use cases where people are saying, I don't care that it's tokenized, I don't care what the underlying infrastructure is, it's just better use of liquidity. So that's I think
that's a really good example, and one I've obviously talked about before. But I think when you think about tokenizing an instrument that today is non-transferable, that's very powerful, just there, because you kind of create a utility, and that ability to get in and out, like you say, intraday basis, again, hugely powerful. But I think it's the utility, then playing on the theme of collateral mobility, you creating a new asset class that ostensibly is an HQLA instrument. So kind of say 1P, one money of these kind of money market funds. So that can be used then to be allocated as collateral for derivatives, repo, securities finance. Very powerful.
It could even be used at some point as a pair against buying other securities, 100%.
Right?
And at a model where the client, the buyer, gets yield up until the second of the trade, and then the seller gets yield right from the moment of the sale. It's very efficient. Now, it also jumps through banks. The buyer could be in one bank, the seller could be in another bank, and instead of doing the intra-bank transfer of the money, they just exchange a money market fund, which can be bought by one client on his bank and then sold on another client on
Absolutely. His bank. Yeah, and another benefit, if you think about when you allocate cash to derivatives, VM or IM, typically you don't get any return. You allocate tokenized money market fund, you'd get the return.
So a lot of use cases. I won't even talk about real estate, which is a massive, massive use case, and private equity, that we just take whole markets that operate by hand and by phone and by Excel sheets and move them into the new world. It just goes without saying. So I think the kind of assets are there. The next thing that you mentioned in order to enable scalability is you talked about liquidity. And I think that one of the key things about liquidity, I'm going to bring it to the subject kind of close to my heart, which is interoperability. Because I think that liquidity is almost born out of interoperability in the market that we have today. Because I think there are basically dozens of people here. Many of you are building tokenization engines, and other issuance services, so the supply side. There are some providers that provide also the buy side, and if there's no connection between them, these assets that are not trading today, if there's no market that is global, it doesn't scale. So I think liquidity is a core core element, and as a result of that, also interoperability is a core element.
Yeah, no, I mean, I definitely agree. I think for me, interoperability kind of plays into like three kind of key components. One, where you can actually have two different kind of networks actually kind of facilitating the settlement of a transaction. We've done that, on a couple of occasions, and I think that's important. There are different ways that you can do that. I think people just assume interoperability means you can just plunk your kind of token on someone else's platform and then that's interoperable. I think it's more kind of the nuance of that. It's the ability to distribute your asset to a variety of different investors, which I think is hugely important. And then that also brings in custody, having custodians, like institutional grade custodians across the different platforms.
Yeah, I totally agree. I think people coming from crypto kind of thinks that interoperability is just meaning moving the token from one place to another. There's a whole life cycle around securities that needs to be managed. There's whole regulatory flows. There are all data that needs to go back and forth. There's a lot more stuff than just the token. But the token itself is maybe 20% of the work. It's just moving. 80% is not the token. And the other thing to be discussed is, again, how do you actually move the token by actually changing the custody, changing who is the custodian, rather than moving it from one blockchain to another, which is in itself very, very complicated. And so there are different solutions to that problem.
Agreed.
I think the next thing that we talked about was when we're talking about scalability, there's also an element of what happens within the banks. Because I can tell you where, as a startup trying to get into the banks and trying to bring all of these technologies, we did spend a lot of time building the technology. Technology is not easy, it's not trivial. But we thought that once we finish building the technology, it will be faster to go to market. The reality is there's a lot of internal processes, new product, legal, and so on. What is your secret sauce? How are you managing this within your organization? How do you think that should be managed in order to reach scale?
Look, I mean, firms are all kind of designed differently. I guess the firm has always prided itself on trying to move through, kind of the internal governance in a very appropriate fashion, but with, in an expeditious way. But there is, kind of a lot of regulatory focus across the globe in terms of, like I said, the right committees that you go to, and there are many different things you need to consider. But I think it's diligent, doing your diligence up front is probably the key, as everyone will know. But for us, kind of key areas, new products, obviously, but kind of thinking more on the reputational side as well. That's kind of probably a little bit of an overhang from the crypto side of the kind of market, but there is a lot of focus on that. And this is still quite nascent, and people want to truly understand what risks are you bringing into the market. So, it can be kind of simple things which are, kind of vanilla products that we trade that have a digital asset flavor, and we'll have to go through the same governance process as we would if we're looking to tokenize real estate, for example.
Yeah. So I think we covered the main things that are breaking or needed for scalability. I think that the next thing to look at is how are we going about doing it. And I think the industry has seen a lot of POCs. And I think, at least in my view, and I'd like to hear from you as well, we should move away from POCs. We should move to actual production, and we should move to things that I would say move even not $1, $100,000 in one direction, and securities in another direction, and do it again and again, and do it with financial institutions, and do it in a way that is scalable.
Yeah, I think from my perspective, this technology is nothing new in that sense. And so you said the technology works. And so there's no appetite, certainly from my perspective, but also from the firms, to continue to do kind of POCs where, there is no kind of scalability at the back end of that. So I think there's a delicate line, obviously, when you're looking to kind of experiment with new technology. But there's a lot of very positive aspects of the work that's happened over the last 4, 5, even 6, 7 years. And it's really, really starting to properly monetize that now. That's the key thing, which I think is less about the technology. It's more about kind of getting kind of the adoption and the scalability.
In models that have the adoption and scalability on two things. One is the project that you're deploying commercially sensible. Is it making money? Is it saving money? Yep. That's one thing. The other thing, once you've done one, can you replicate it 1,000 times the next day?
Yeah, exactly.
If you answer,
that's how I think about scalability. It's not something that you'd use once, you incur all the legal costs, and then you can't use it again. It's something that you can then leverage, with different issuers, different clients. That's kind of real, true scalability in my mind.
Yeah.
And I think the point about the commercial side, again, that's kind of obvious. Is this going to kind of create cost savings? Is this going to create revenue opportunities? Does it de-risk the system? Because I think a lot of what we're all collectively focused on actually does have a really profound impact on reducing a lot of the risk that we see in the market today, which can only be positive.
Yeah. I think that one other thing that I would like to mention in terms of closing the gap between our preparation to go to market and scale is the discrepancy between supply and demand. I think that right now the market is leaning supply. There's a lot of activity, bring assets to market and so on. And then once you finally get the supply out, are you actually connected to the demand? Are you seeing it the same way? Do you think that demand is now the next battlefront?
I think demand comes back. I mean, liquidity is the key to all markets functioning kind of efficiently, and it's really that simple. And so I think supply, there's kind of an inordinate amount of opportunities on the supply side, and so then it's really identifying the ones, going back to what we talked about, that are commercial, etc. I think the demand's definitely there, but it needs to have the right features to make it attractive, and liquidity is one of the key ones, and obviously products that resonate.
Yeah, actually, when there was a recent survey by EY that went to financial investors, to high net worth individuals and so on, and they did a pretty big survey about their interest of investing in tokenized assets. The interest is definitely surprisingly there. It's very high numbers, and what people expect to get from it is exactly the advantages that we talked about. More access, which they're willing to pay for, more liquidity, more capability to do things like leverage and so on. I think that what happened in the market really was that on the financial institution side, there was no supply, so there was no demand. There was no demand, so there was no supply. Now supply is coming in large number, and because supply is coming, there's an opportunity for the demand to join and come in as well.
100%. I think that's kind of one of the, I guess when you talk about democratization, that can also manifest itself even at the family office, high net worth level as well, where people presently don't have access, they get access to kind of investment opportunities. That's a real positive. So you are increasing the liquidity pool. The one that you didn't mention was transparency. I think that's also a key one as well.
And quality information, which can then be turned into, you can push into an AI machine and start to get all sorts of insights.
Absolutely.
Yeah. And I think that, at least from the way that I look at it, if I look at the timeline, for me, the year 24 is the year where 23 was a lot of POCs, right? Done, been there, done that. 24 needs to be about going to production live in an interoperable manner, where we have multiple financial institutions trading between them, assets and projects which are commercially viable and scalable and replicatable. And then 25 should be the year where we're doing the exponential growth. I mean, that's my
I think that seems reasonable to me. I mean, I do think, not wanting to name drop, but I think someone like Larry Fink, I think, has had a profound impact. Not only on the buy side, because people are like, well, what are BlackRock doing? Because they do have a multifaceted strategy, but then also on the sell side, because they provide so much in terms of dollars to the market. So I think, that's been good. So I think mobilizing, kind of, I guess, more market participants, the demand, I guess, is hugely important. So I think next year, even if it's a small number of projects, but you have the market coalesce around them, create the liquidity, and actually show that there is value there, I think, to me, that will happen, and that's going to be key. And then I agree. And then it becomes kind of, people don't need to talk about tokenization, underlying technology. And we held a conference in New York a couple of weeks ago, and Christy Moy, I'm sure many of you know, she was just spot on. Like, if you're a trader, you don't want to be talking about tokenized assets. You don't want to be talking about what software you're using. It's really just kind of what benefits do you extract. And, if I'm trading whatever market is and the capital I use is less, the liquidity costs are cheaper because we're just more efficient, that's a positive. You don't need to know any more than that.
Yeah, and for those of you who are going to be here later, Emmanuel Aido is going to do a talk as well on the same subject of scalability, the deployment in the market live and so on. But before Matt and I talked before this thing, and we both like to answer questions from the audience. So we thought we'd open the forum and take any question you may have for Matt or myself. So anybody who has a questions, please take the microphone.
Well, Amy will pick someone.
There's always a question. Somebody has to go first.
Lawrence.
Well, fantastic as always, listening to you both, Matt and Amy. So let's talk about putting 24, 25 in the run to 2030 into context and scalability. I'm always reflecting on the market and believing we're in probably the most complex political and macroeconomic period in our lives here. I like to extend that to my father's life. Bless him, he's not with us anymore, and almost right back to my grandfather, talking about the great crash of '29 and the political upheaval of Europe. And I don't want to be dismal about this, but with that sort of a prospect, we focus on liquidity. So look at what's going on in the US, inflation. I think my American friends quite often are a bit tone deaf on de-dollarization and how active an agenda that is in other parts of the world. So let's come right back to the scalability point, Amy, which I love. 24, most folks in New York a couple of weeks ago said, look, we've got our heads down, let's just get through 24. But when we talk about this adoption, and particularly some of the buy-side inertia you spoke of, Matt, which is just, sell-side, we're great at creating products, but buy-side is like, well, what are we going to do with them, and when are you going to get the stuff in them that we want? What are we looking at from 25 to 30 in terms of some sort of a scalable path? And what asset classes? So you mentioned property, and you put it at the back of the queue, Amy. What's the sort of roadmap from 25 to 30 on products and scalability?
Yeah, I mean, there's quite a lot in that, to be fair to people. I'll be kind of quick. But yeah. But I mean, in terms of, I'll take the last question first, actually, on the product side. I mean, it's my personal belief, and others, may feel differently, but I genuinely feel the more vanilla products are the ones that will see real scale. They're probably not going to deliver the same level of benefit, kind of in the longer term, but what they do, people are familiar with them. The money market fund tokenization, obviously JP did something, with BlackRock just recently. And then when you think of securities, again, it's a market people are very familiar, and it's easy to scale just given the quantums within those markets. So I actually think creating marketplaces in and around those types of products next year will demonstrate that you have the secondary liquidity, you're starting to increase the adoption, and then I think that then feeds into confidence, more participants, and that's when the product suite will kind of broaden. I do think there will be, real life work in the real estate space, but I just don't think another real world assets, but I think it'll probably be smaller. I think you'll get the biggest scale on the vanilla side. And then, in terms of adoption, digital money really is kind of quite key to all this as well, because you really do want to have a seamless kind of on-chain, transaction, P versus P or DVP. And so, really kind of getting scalable digital money, which I think is a good 12 months away, really, probably longer than that, quite frankly, probably 2 to 3 years. So I do think you're going to see kind of a big kind of uptick in adoption next year, probably towards the middle end. And then I think, 2025 to 30, I think it's going to be the broadening of the product suites and therefore kind of deeper pools of liquidity.
Yeah, so we actually did this exercise of what is it required to do in 24 and 25 and 26 in order to reach the 5 trillion at 2030. And we're working on this with multiple partners. So what I can see with my vision is things launching in the money market fund, and that will be talked about later today, as I said. So that's immediate. And was done already by JP Morgan, was done already by Archax with Aberdeen, and then Wisdom Tree in the US, and Franklin Thompson, so there's a lot of that. Next thing you're going to see is a lot of real estate projects that we're working on, because it's a market ripe for disruption, and there's a lot of value for both sides, for the sell side and the buy side, so we do a lot of that. Later today, there's also going to be a discussion with about the repo project that we're doing with JP Morgan, HQLAX, and WeMatch. So that's another thing that's coming in to the pipe. And then we're going to see a lot of stuff around private equity. And everybody's looking at bonds, various ways of making the bonds market more efficient, and you're seeing that with the likes of Euroclear and D7, Deutsche Börse, DTCC, and we've done actually last month we've done a ESG bond with a US bank in production. So all of these are things that are being done. They're being done in a way that is more and more scalable. D7 did one, and then they did 1,000. right? It's exactly those sort of things. If you do one, you can do 1,000 because the one is the hardest, right? And then that's the model. So 24 is the year where everything is going to go live and in a scalable manner, but 25 is when it starts to get exponential. And when it gets exponential, anybody who has any experience with digital markets, right? You know, once you have it, and for us, the key thing is that in 24, it will not just be in production, but it will also be interoperable. We want to see one bank issuing, 5 banks buying, another bank issuing, 5 asset managers buying, or 10 asset managers buying. That's the whole model. Without interoperability, you don't get the supply and demand, you don't get the liquidity. If all of that is deployed in 24 as we expected, 25 is exponential.
I think you just highlighted a couple of things that we've been talking about. Sorry, on the money market funds, I think Archax and WisdomTree, it's great to see them, but that's kind of very heavily retail for the moment. And what you need is the scalability. The technology has been proved it can work, which is fantastic, but you need to scale it in a way that institutions can easily get access. And the same for private equity. You see something in Australia that's been very effective, but again, it's just a microcosm of the broader market, and you need to scale that globally, and that's where you need to go.
Mike is standing there. I know this look.
I think the lunch is downstairs, so I really appreciate everybody staying here and appreciate the conversation. It's really a step change from last year. Thank you.